Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to start things off today by examining last week's Federal Reserve action, where rates were hiked by 75 basis points. Now, this was widely expected, and the lesser of two options that were on the table. There were quite a few market participants coming with a forecast that there would be a full 100 basis point rate hike, and they only chose the path of 75 basis points. On the surface, that would seem relatively dovish or accommodative to the economy going forward. But their statements that were released along with the actual action were a much different story. So this is what's called a dot plot, and essentially it's a poll of all the different people involved in the decision making, the Fed governors, and where they think rates are going to be in the future. And as you can see, out in 2022, the median forecast is somewhere up near close to 4.5%, 4 3/8. And for 2023, it goes up to almost 4 2/3. And when we start seeing these numbers, take them in the context of what happened in the last meeting where this was discussed in June. At that time, the Fed was expecting rates to be under 3.5% at the end of this year, and only about 3 2/3 on average for the end of next year, with a turn down in 2023. That's no longer the case. Clearly, we've gone up by almost a full point in each case, and we've pushed out the lower rates being materially lower into 2024. Now, when we start seeing moves like that in the Fed's expectations, along with statements that they're willing to do, quote unquote, whatever it takes to rein in inflation, including the potential to cause a recession, well, markets don't tend to like that. And this is how we got this action last week, starting from the day of the release, about a 6.5-7% decline in the S&P, all the way to retest, or levels that are close to retesting, the lows from this move that started out earlier this year as we entered into challenging market conditions. Friday, it bounced off of this level, but it appears we're going to open up below it to start the day. And if that happens, there is potential further downside to the market, although how far it can go remains to be seen. And it is volatile conditions that are based on these macroeconomic news items and this risk-on, risk-off sentiment that's driven by the twin concerns of inflation and a possible recession that are caused by the efforts to combat that. So data that's going to inform what's likely to happen over the next few weeks, there's quite a bit of it. We're going to get this week some important data. Tomorrow, durable goods orders gives us an idea of what's happening with demand. Is it slowing more or less than expected? The consumer confidence is probably the most important item until we get to Wednesday when the GDP revision comes out for second quarter GDP growth. And we'll see, was it accurate? Are they going to revise the number to say that the economy was stronger than they thought it was, or are they going to revise it to say it was weaker? That has bearing, all of that, on whether the Fed has more room to push rates higher without pushing us into a deeper recession. And that's going to be key to what markets are thinking about. Income and spending, well, the consumer is about 2/3 of our economy, so we want to know what happens with the consumer and are they spending, are they pulling back? Sentiment measures basically the same thing, and the Purchasing Managers Index coming out later in the week measures whether the businesses think that things are improving or declining in the economy. And we'll get those numbers. Coming out next week, we have the ISM manufacturing number, which will be important. Factory orders. Are things continuing to be ordered? Is there more demand in the economy? Going later into the week, we'll get more numbers on employment. And this is going to be key as we go forward. Are we starting to see signs of layoffs and potential weakening in the job market? That's a signal that the market's going to be watching for very carefully. And that's really what we have on the economic front. And there is good news for fixed income investors, because what we've been seeing in the bond market is now the yield curve, even out to 3 months in high quality corporate credit, is above 4%. And that means that fixed income investors are doing relatively much better than they have in many years. I mean, 10-year paper, you can get over 5% now, 9-year paper. So this bodes well from the bond perspective. And going back to equities, yes, it's a challenging and scary time, and volatility is elevated, suggesting that we see more potential downside. But we're not focused on this, which looks like a relatively scary pattern that's near its bottoms and potentially piercing lower. We pay more attention to the longer term as investors, where we see that we are up quite substantially, and there are areas in the market that are supportive of prices underneath where we're at. So is it a time to be nervous and sell your stocks? We do not believe that is the case. We believe that it is important to adhere to your long-term investment plan, and we'll continue to advise you in doing that, even in challenging times like this. So if you have questions, if you have concerns, please give us a call. We're here to talk. Thank you. We hope you found this to be useful. Have a great day.